Sometime in the last 30 days, money left your bank account and you didn't think about it for even 1 second. It wasn't rent. It wasn't your car payment. It was an auto draft to an insurance company. Maybe $200, maybe $500. It hit, the balance dropped, and you moved on with your life. You didn't get a product. Nothing showed up at your door. No box, no service, no experience. You paid money for the privilege of nothing happening to you. And here's the part that should bother you a little. That company is thrilled about it because from where they're sitting, you didn't just buy a policy. You made them a loan. I'm going to say something that took me about 8 years in finance to actually understand, and I want you to sit with it because everything else in this video depends on it. An insurance company is not in the business of protecting you. An insurance company is in the business of holding your money. The protection is the excuse. Holding the money is the business. Think about the sequence. You pay first, they pay later maybe, sometimes way later, sometimes never. In between, they've got your cash, and it's sitting in their account earning them money that you will never see a dollar of. Warren Buffett has a word for that pile of cash. He calls it float. And as of the 30th of June 2026, Berkshire Hathaway was sitting on roughly $177.5 billion of it. $177 billion of other people's money, not borrowed from a bank, not raised from investors, just collected from people paying car insurance bills they never read. So let's talk about what it actually takes to own one of these things, because it is one of the strangest businesses on earth, and almost nothing about it works the way you'd assume. The scoreboard nobody outside the industry knows. Every industry has one number that tells you if you're winning. Restaurants have food cost. Retail has same-store sales. Insurance has the combined ratio. Here's how it works, and it takes 20 seconds. Take every dollar of premium you collect. Now subtract what you paid out in claims, and subtract what it cost you to run the company. Whatever percentage of that premium dollar you burned, that's your combined ratio. Under 100, you made money on the actual insurance. Over 100, you lost money on it. That's it. That's the whole scoreboard. And here's what's wild. For most of the last 2 decades, the American property and casualty industry has hovered right around 100, meaning collectively, the entire business of selling insurance in this country roughly broke even. Some years slightly up, some years slightly down, which raises an obvious question. If they're breaking even on insurance, how is anybody getting rich? They're not getting rich on insurance. They're getting rich on the float. Now, right now, happens to be an unusually good moment. AM Best Projects, the industry combined ratio, improved to about 95 in 2025, up from 97.1 the year before, the strongest performance in 10 years, with net underwriting income more than doubling to an estimated $39 billion. A big reason? An Atlantic hurricane season that didn't put a single storm on U.S. soil. Read that again. The industry's best year in a decade happened partly because the weather cooperated. That's your first real lesson about owning an insurance company. You can be brilliant, disciplined, perfectly priced, and your year still gets decided by whether a low-pressure system off the coast of Africa turns left or right. Denise. And the business of pricing something that hasn't happened yet. I want to tell you about a woman named Denise Alvarado. She's an actuary. I met her about 11 years ago at a conference in Hartford, which is the least glamorous sentence I have ever said out loud, and we've stayed friends since. I asked her once genuinely, not as small talk, what her job actually is. And she said something I've repeated probably 50 times since. She said, "My job is to sell you something today, at a price, when I won't know what it cost me for another 4 years." Sit with that. Every other business on the planet knows its cost of goods. A restaurant knows what the salmon cost. Apple knows what the screen cost. An insurance company writes a policy in March, and the accident happens in November, and the lawsuit gets filed the following June, and the case settles 3 years after that. So, you're not pricing a product, you're pricing a forecast. And you know what forecasts do. They're wrong. The only question is, Which direction? Which brings up the single most under-discussed line item in this entire industry: reserves. When a claim comes in but hasn't been paid yet, the company has to guess what it'll eventually cost and set that money aside. That guess goes on the balance sheet as a liability. And here's the uncomfortable truth Denise walked me through over bad conference coffee. That number is a judgment call. A very educated, heavily modeled, regulator-reviewed judgment call, but a judgment call. Set reserves too low, and your profits look fantastic. This year, right up until the claims come due and you have to go find the money. Set them too high, and you've buried real earnings in a rainy day fund. In 2024, the industry added over $9 billion to reserves for older claims, the biggest boost in at least 15 years. That's the sound of a whole industry quietly admitting its earlier guesses were too optimistic. So if you own an insurance company, understand what you actually own: a very large, very leveraged opinion about the future. Ray, and why claims are the real factory. Second person, Ray Mendoza. Ray adjusted auto claims in Phoenix for 19 years before he moved into management. Ray is the reason I stopped thinking of claims departments as customer service. A claims department is a manufacturing floor. It's where the actual product gets made, and its efficiency determines whether the whole company lives. Ray explained the two forces that decide his world: frequency, how often people crash, and severity, how much each crash costs. For decades, frequency has been drifting down. Cars got safer, airbags, stability control, automatic braking, fewer crashes per mile driven. Great news, right? Except severity went vertical, because that same safety tech is what makes a modern car cost $12,000 to fix when you tap a curb. That bumper isn't a bumper. It's a sensor array wearing a bumper costume. And it's not just the cars. Ray watched it happen in real time on the injury side. Lawyers got more organized. Litigation financing showed up outside investors funding lawsuits for a cut of the settlement. Juries started handing out awards that used to be unthinkable. The industry has a name for this: social inflation. And the giant verdicts, the ones with 8 or 9 figures, they call nuclear verdicts. It's why commercial auto and general liability were basically the only major lines still losing money on underwriting in 2025. Litigation pressure and claims severity just kept climbing. You can price a car crash. Pricing a jury is a completely different sport. And here's the thing that keeps claims executives up at night, which Ray put better than any textbook: you can be too good at claims. Squeeze too hard, deny too aggressively, and you don't save money. You manufacture lawsuits, regulatory complaints, and a reputation that costs you more in lost renewals than you ever saved on payouts. The optimal claims department isn't the cheapest one. It's the one that pays fairly, fast, and gets out of the way. Hal, and the hidden killer nobody talks about. All right. Third one. Hal Brennan owns an independent insurance agency in Ohio, third generation. His grandfather started it. Hal is where I learned that the expense side of the combined ratio is where most insurance companies actually die. Because here's what nobody tells you. Getting a customer in this business is brutally expensive. You're selling something invisible that people resent buying in a market where your competitor's identical product is 1 click away and $40 cheaper. Hal takes a commission on every policy he places. That's a real cost that comes off the top before a single claim is paid. Or you skip Hal, go direct to consumers, and then you're buying your customers with advertising instead. Want to know what that looks like at scale? In the first quarter of 2026 alone, Progressive spent $1.5 billion on advertising. That's a 20% jump year over year. 1 quarter. $1,500 million of Gecko-adjacent commercials to keep the funnel full. And the difference between doing this well and doing it badly is enormous. Geico runs an expense ratio around 12.8 points. Progressive's is 25.5. That's a nearly 13-point gap in what it costs each of them to put a policy on the books before anyone crashes anything. 13 points of premium on a business where the entire industry's underwriting margin is like 4 or 5 points in a good year. That's the whole ball game. That's why the giants are giants. Not because they're better at predicting car accidents, everybody's models are converging, but because they're cheaper at acquiring the human being. Hal said something to me over lunch that I think about constantly. He said, everyone's obsessed with the loss ratio. The loss ratio is weather and math. The expense ratio is you, Priya, and the lesson technology can't teach you. Fourth, Priya Raghavan. She was building an insurtech startup around 2019, and she let me look at her model, and I'll be honest, I loved it. Mobile first, AI claims handling, 30-second quotes, 90 seconds to a payout. Beautiful. I asked her one question. I said, what's your target loss ratio? And she gave me a number. And I said, okay, how do you know? Long pause. Because that's the trap. Technology can absolutely fix distribution. It can obliterate the expense ratio. It can make buying insurance feel like ordering a car instead of filing taxes. All of that is real. What technology cannot do is give you 20 years of claims data on a book of business you haven't written yet. Here's the brutal loop. To price risk accurately, you need loss history. To get loss history, you have to write policies. To write policies, you have to quote a price, which you're doing without loss history. So every new insurance company starts by being wrong. The only question is how wrong, and whether you've got enough capital to survive finding out. And there's a worse version of the trap. If your prices are systematically too low, you don't fail slowly. You grow explosively. Because you're the cheapest option in the market and customers pour in, and every single one of them is a policy you're losing money on. You are the most successful company in America right up until the claims mature. The industry has a phrase for this. Growth is not a strategy. Growth is a symptom. You can see the tension in the public numbers. Lemonade's net margin for fiscal 2025 was roughly negative 22%, deliberately spending ahead of profitability to buy scale, which is a completely legitimate venture strategy. It just isn't an insurance strategy. Those are two different companies wearing one logo, Marisol, and the 6 good years. Fifth, and this is the one that'll stick with you. Marisol Reyes was part of the founding team at a small Florida homeowners carrier. Started in the mid-2010s, and for about 6 years, that company was a machine. I want you to understand how good it looked. Florida homeowners' premiums are enormous. The state was underserved. Big national carriers were pulling back, which meant less competition. They wrote policies, collected premium, paid out routine claims, a roof here, a water leak there, and the money piled up. 6 consecutive profitable years. Marisol was buying her parents a house. Then a hurricane. Not 6 hurricanes, 1. And here's the mechanic that most people never learn. Catastrophe risk isn't a bigger version of normal risk. It's a completely different shape. Normal insurance works because your risks are independent. My fender bender in Denver has nothing to do with yours in Seattle. The law of large numbers protects you. A hurricane makes every single policy in a 100-mile radius file a claim on the same Tuesday. Every year, you don't have a hurricane, you look like a genius. And you're not accumulating profit, you're accumulating exposure. Look at what that market has done to consumers. Florida homeowners insurance now averages north of $10,000 a year in some analyses, with premiums up nearly 50% from 2020 to 2025, while inflation ran under 28%. The second most expensive state in the country, Oklahoma, is about $3,000 a year cheaper. Insurify +2. Now, credit where it's due, the market has been clawing back. Florida's Citizens, the state-backed insurer of last resort, cut rates by an average of 8.7% for 2026 renewals, and its policy count dropped 50% in a year. As business moved back to private carriers, reforms worked, capital came back, value penguin, but Marisol's company isn't around to enjoy it. 6 good years, 1 bad afternoon. Terrence, and the insurance company's insurance company. 6th, Terrence Wu, reinsurance broker, spends an unreasonable amount of his life in Bermuda, which is not a coincidence. So, insurance companies buy insurance, obviously. If you're writing hurricane risk in Florida and your entire company is worth $200 million, you cannot personally absorb a $4 billion storm. So you go to the reinsurance market and you buy a layer. You say, I'll eat the first 50 million of losses from any single event. Above that, it's yours. That contract is the only reason a small carrier can legally exist in a catastrophe state. Regulators check it, rating agencies check it. Without it, you don't get to open the doors. And here's what Terrence taught me, which is the thing that made reinsurance click for me forever. You do not control the price of your own product, because reinsurance is cyclical, and violently so. After a quiet few years, capital floods in chasing returns, reinsurance gets cheap, and everybody's margins look great. Then a big event hits. Capital gets vaporized, survivors demand way more money for the same coverage, and your cost of goods sold just doubled at renewal. You didn't do anything. Your book didn't change. A storm hit somebody else and your economics broke. That's the part outsiders never see. A small carrier's profitability is set in a conference room in Bermuda every January 1st by people who have never heard of them. Wendell and the Backdoor, 7th. And this one's practical, because at some point you're going to ask, okay, can a normal person actually own a piece of this? Wendell Pratt runs a mid-sized trucking outfit, 90-some trucks. And about a decade ago, Wendell got tired of writing enormous checks to his commercial auto insurer every year while running a genuinely safe fleet, good drivers, telematics, low claims. So he formed a captive. A captive is an insurance company you own that insures your own business. Wendell's captive collects premium from Wendell's trucking company. It pays Wendell's claims. And if Wendell's safety record is better than the market assumed when it priced him, which it was, that difference doesn't go to a carrier in Hartford. It stays in a company Wendell owns. He's not gambling. He's harvesting the gap between his actual risk and the industry's average price for people like him. Now let's talk about the front door, so you understand why the back door exists. On paper, the capital requirement to start an insurer isn't insane. Texas requires $2.5 million in capital stock and $2.5 million in surplus for a property casualty company. $5 million bucks. Sounds almost reachable. It's a fantasy. Because on top of statutory minimums sit risk-based capital rules and regulators who look at your business plan and set your actual requirement based on what you intend to write. Pennsylvania states this outright. The commissioner requires new insurers to demonstrate surplus over the statutory minimum with the exact amount depending on your forecasts. Agent sync. Translation. The number isn't 5 million. The number is whatever they say it is after they read your plan, usually tens of millions. Then multiply by every state you want to operate in, each with its own filings, its own rate approvals, its own timeline. You don't just need capital. You need capital that can sit idle for years while regulators decide whether you're allowed to exist. Which is why almost everyone who actually enters this business does it as an MGA, a managing general agent. You do the underwriting, you do the distribution, you own the customer relationship, and you rent someone else's balance sheet to legally carry the risk. You take a fee instead of the underwriting profit. Less upside, way less capital. And, critically, a hurricane can't kill you. Why anyone does this at all. So let's land the plane. If underwriting roughly breaks even industry-wide, and the expenses are brutal, and one storm can end you, and regulators control your prices, and reinsurers control your costs, why does anyone want to own an insurance company? Go back to the float. Berkshire's float sits at about $177 billion, and the key detail is this. Because Berkshire has a history of actually earning underwriting profits, that float doesn't cost them anything. It generates income. Coverager. Read that one more time. They are being paid to hold $177 billion of other people's money, which they then invest for their own benefit. There is no other business structure on earth that does that. A bank pays you interest for your deposit. A bond issuer pays a coupon. Berkshire found the one place where the lender pays them for the privilege of lending. And the value of that swings with interest rates. In a zero-rate world, float is nice. When yields are decent, float is a money printer. The exact same book of business becomes dramatically more valuable without you selling a single additional policy. That's the real business. That's why insurance companies get bought by conglomerates and private equity firms who don't care about insurance at all. They're not buying the policies. They're buying the ability to hold the money. So the next time that auto draft hits and you don't think about it for 1 second. You're not a customer. You're a depositor at a bank that hopes you never make a withdrawal. You handed over your money, and somebody else is earning the return on it, and the entire industry is built on the fact that you find the whole thing too boring to look at. Everybody in insurance knows this. The actuaries know it, the reinsurers know it, the guy who bought your carrier last year definitely knows it. Now you know it too. If this changed how you see that bill, hit subscribe. I'm working through the real economics of a different business every week, and I'd rather build this list with people who actually want to understand how the money moves. And drop a comment with what you want next. Someone's going to say, credit rating agency? And honestly, whoever says it first, I'll do it. See you in the next one.